Hi everyone, it's Shauna here. Welcome to All Things Mortgage. On today's video, we're going to be talking about LMI. What is LMI? So LMI stands for Lender's Mortgage Insurance. When you're planning on purchasing a property, if you're going to borrow more than 80% of the home's value, then you can expect to pay LMI to the lender. This is also true if you're planning on refinancing. If you refinance and you have less than 20% equity in the property, then you'll be responsible for paying LMI again. Let's take a look at an example with a purchase price of $500,000. So in this example, you've worked very hard and you've managed to save 10%, which is $50,000. Other costs to consider when you're purchasing a property would be your borrowing costs. And borrowing costs could be anywhere from $3,000 to $4,000. And these include things like your conveyancing fees and application fees from lenders. And then we have the LMI, as we've provided a 10% deposit, not a 20% deposit. I've used $12,000 as the LMI as a worst case scenario for $500,000. But each lender will have different criteria. It could be higher or lower than this amount. And as the purchase price increases, so does the LMI, because the lender needs to cover that risk in lending the money. LMI can be paid out in two different ways. The first way is that you can pay that $12,000 straight up at settlement, in which case you would actually need to have $66,000 saved before you can get into that property. The other way that you can pay LMI is to have it added on to your mortgage and pay it off monthly. However, in this case, you will end up paying interest on that $12,000 and it will cost more in the long run. So typically when we think of insurance, we think of it to protect us, the consumer. But in this case, LMI protects the lender, not the borrower. So I really hope you've enjoyed my video on LMI. Thanks for watching, and stay tuned for tomorrow's video where I'll give you 3 tips on how to avoid paying LMI.